and the 200. The market has two states. I've taught you this: narrow and wide. The market has two positions: above everything, and just like Baba today, below everything. The market has two actions: buy, sell. The market has two results: gain, loss. And the market has two types of players: depositors and withdrawers, winners and losers. Traders, this is a game of twos. If you get the twos right, you are head and shoulders above the vast majority of people in the world in this game. I believe that the 92% failure rate that we experience in the short-term oriented trading game is largely due to overcomplication. There are other things like lack of education, lack of training, thinking you can do it on your own, playing with inappropriate or inadequate amounts of money, showing up to a gunfight with a knife and thinking you have a chance to win. All of those things do contribute as well. But there's also this tendency to overcomplicate things. And I don't want you to make that mistake. If your trading plan does not fit on one sheet of paper, right? If it doesn't fit on one sheet of paper and it's more than 10 lines, it's freaking too complex. Go back to the drawing board. You should have 8 lines, 10 lines max. It shouldn't even fill up a piece of paper. If your trading plan's pages, you've already lost. Do you understand? Because the market only goes up and down and sometimes sideways. So what are all these pages for? The market only has 2 colors, red and green. What are all these pages for? What are you doing? Guys, and let me tell you this. On my journey, which was a long, dark 6 years, 5 and change, but let's round up to 6 years of just straight losing. Many years in depression, sleeping on the couches of friends because I would rather put money into the market again than pay my rent, right? During these years, I forgot my point. I forgot what I was going to say. Maybe it'll come back to me. All I'm saying, oh yes, during these years, I was in search of the Holy Grail. I studied every possible thing you could study. I used every tool, every indicator. Guys, I even studied deep levels of astrology, all right? Planetary alignments that coincided with major tops and bottoms in the market. I went way off the frickin' deep end. Do you understand? Believe it or not, there is a little bit of validity to that, as strange as that may sound. But anyway, I went all the way off the deep end, searching for the Holy Grail, only to come back beaten up come back to the basics. Beaten up, destroyed, depressed. And it is upon my return back to basics that I realize, oh my God, it's right here. It's always been in here. It's in the color red and green, up and down, beneath, below, and frickin' follow the trend. And that's it. If you make it more complex than that, it will be more complex than that, but it doesn't have to be. Do you understand? Do you understand what I'm telling you? Are you picking up what I'm laying down? Tell me. I want to see your comments here. Tell me. Tell me. Is it? Yes? Let me know. All right. Yes, awesome, man. I appreciate it. Thank you. Now, one last thing I'm going to do with you. One last thing I'm going to do with you is this. Let me go back to it. If you go to my Instagram or even Facebook, Instagram page, right? And you watch my story, I posted a story of the result of my trade today, and you'll see that I made over $7,000, but the majority of it was on this trade, BABA. Okay. Now let me show you. I want to show you in a way how I did this, because you see here, doing this here in a second here. This was done very simply, and believe it or not, I didn't even catch the big move, which is crazy because I'm always spending time with the traders on their trades and I miss so much. But guys, I shorted this move to the upside. All right. And as soon as I shorted, it collapsed and I covered. Then I shorted this move, the new high. Why? Because I told you 72% of all new highs fail. Boom. And I covered. And I wanted to get this move. If you listen to the story really carefully, listen to the beginning of it. When I'm saying to my traders, after this one, I will do it again. Listen carefully. If you go to my Instagram story, you'll see me saying, on the next move, I want to do it again. And you'll see a trader of mine asking, Oliver, are you going to short BABA again? Because this was 2, right? Boom to the down, boom to the downside, and boom to the downside. And I'm saying, I want the next one too. But I didn't grab the next one because I was teaching. See how much my students cost me? A lot. Now, very quickly, this is simple. So check this out. Remember I told you when you have a move, right? Let's take a move like this. Let's do it red. You have a move down like this. Remember I told you how to divide this? I told you to cut it in half. Do you remember that? Let's do that a different color. I told you cut it in half and then do the 1/3 cut and the 2/3 cut. And this box is where I want to act, right? So if this stock, which moved down like this, if it moves back up into that box, I want to start shorting it. Boom! Because the odds are that, right? So if you look carefully, look at this move down. And where's the half? About there. Where's the 1/3? About there. Where's the 2/3? About there, more or less. And you take this zone and that's where most of the time the turn's going to happen. Do you understand? And so here is the major short. That was the most major one there. Boom. And guys, that's a big move. That's like $1.50 move. 1,000 shares, that's $1,500 in like 45 seconds, a minute. Money is not in the market. Stop trying to find money in the market. It's not there. The money's in you. You unlock the money. The money is inside of your decisions. If you never show up to the market, can there be money? No, it needs you. You bring the money. The money doesn't exist there, it exists here. If you improve your decisions, you unlock the money. If you stay the way you are, the money stays locked inside of you. People are looking in the wrong direction. They're searching in the market for a secret. They're searching for a system. They're searching for something outside of themselves. You have to improve you. And that improved you improves your decisions. The improved decisions unlock the money. Your decisions have the money, not the market. The market is neutral. The market is like a freaking hammer in a carpenter's toolbox. No carpenter in the world, right, says there's money in my toolbox or there's money in my hammer. Every carpenter in the world will say, no, I use the hammer to make money. I use the market to make money, but the money is in me. It is not in the hammer and it is not in the tool. Do you realize that the market is our hammer? Invest in yourself. Invest in proving your decisions. Invest in becoming, don't invest in better tools. Don't invest in a more expensive hammer. Don't be searching for a fancy freaking screwdriver. Don't get an expense. Don't put your effort in trying to get, a nice shiny red carpentry toolbox and a beautiful leather belt. Right? Invest in becoming a better carpenter. A better carpenter with dull tools can blow out of the water an untalented carpenter with the best tools. It's not the tools. It's not your trading platform. It's not your broker. I am telling you, it's you. And this is what I love about this game. It's just you. You and your tool, the market. You can't blame anyone. You can't point the finger. Oh, traders do this all the time. But all you should do is laugh at them, because at the end of the day, no one forces you to press the buy button. And in most of your cases, you click the buy button. But no one forces you to click or press the buy button. And no one forces you to click or press the sell button. No one. It's you and your tool. That tool is neutral. Baba trades the same for me as it trades for Warren Buffett. No different. It's a neutral tool. The money is inside of your decisions, inside of you. Improve you, and you improve your decisions. When you improve your decisions, the money rains down like freaking manna from heaven. You don't see it? It's falling on me right now. Manna. All over the place, all over the floor. All right, okay. All right, the three bottoms. Stocks bottom in three different ways. Now, in truth, they bottom in a variety of ways, beyond three, but these are the three major ways. It's not necessary to delve into all the ways. These are the three most prevalent ways that markets bottom, okay? Now, the first bottom, I'm going to draw this for you, all right? As I've explained to you that I've been teaching traders for 30 plus years. And what I've learned is that a combination of slides and drawing is exactly what helps the trader retain the information. So instead of having a pre-made slide, sometimes I have that, and sometimes I like to draw in your faces, in tus caras. Okay, look. So the V bottom is very simple. It's exactly what it is. It's that drop, that collapse into a low, and a roaring back of the low to leave behind a V bottom. Now, this, I must tell you, is the rarest of the three. This type of bottom, which actually was the predominant bottom back in March of 2020 for most financial markets. This bottom does not happen as often as the other two bottoms I will explain. This bottom is the rarer of the three. And let me explain to you why. All right. It's important to understand what this bottom is, the V bottom, but I also want you to understand why this is rare. This is the rarest bottom of the three I'll explain. All right. This has everything to do with what I call my dead cat bounce theory. All right. Now, here's how my dead cat bounce concept works. When a stock collapses to the downside, it is not very often that the immediate reaction back to the upside is real. In the vast majority of times, that immediate knee-jerk reaction back to the upside, that's false. That's what I call a dead cat bounce. Now, the way I've explained this in the past, and guys, I'm an animal lover. I love cats. I have cats and dogs. So don't take any offense at this. It's just a metaphor. Let's say you were to take a cat, all right? Or a cat were to slip off of the floor, off of the top floor. That's not a cat, but you understand what I'm saying. And fall all the way from a very tall building and hit the pavement. Boom. Unfortunately, our little kitty would not survive that drop. At the point of contact, at the point of impact, the cat is dead. I'm sorry, it's just dead. Okay? The body of the dead cat might bounce. The carcass might bounce. But that does not mean, just because the carcass is rising, that the cat is alive. That is why we call it a dead cat bounce. So in the vast majority of times, this bounce, this initial knee-jerk reaction, this initial bounce after a climactic drop to the downside, that initial bounce is not real. You can't trust it the vast majority of the time. And therefore, what will subsequently happen the vast majority of the time is a subsequent new low. So you'll get this drop, contact with the floor, bounce, boom. Again, I'll draw it again. Drop, impact, bounce, drop to new low. That's the dead cat bounce. So it's important to understand that the first knee-jerk reaction after something violent to the downside is not often real. But every now and then, it is real. And when it is real, it's usually very powerful. Now, this makes this bottom the most difficult to grab. The V bottom is the most difficult one to play because the assumption is that the initial knee-jerk reaction is not real. Right? But that is the first bottom. All right? It is the rarest of the three, but it's important that you understand it, and it's also important that you understand it is the most difficult one to actually grab because the move back up is being doubted by us all the time. Okay? Now let's come back to this and go to bottom number 2, where you have the higher foot bottom. Now I have other terms for this that I spend time explaining to my traders, but for general purposes, we're going to call it the higher foot bottom. This bottom works like this, where you have the stock is making a series of lower lows, and there is a declining, typically, there is a declining 20-period moving average. Now, this is the quintessential higher foot bottom, okay? 20-period, simple moving average is declining with your stock. So you've got a declining stock and a declining 20-period moving average. That's criteria 1, those two things together. Declining stock, declining 20-period moving average. And then all of a sudden, boom, something changes in the stock. A move for the first time cracks the 20-period moving average. For the first time, a move up managed to get through the 20. All the prior moves up did not get through the 20. Every move up failed to get through the 20-period moving average. And now for the first time during the duration of the down move, the stock is showing you an ability to do something that it wasn't able to do before, break through the 20. That's criteria number 2. So remember, criteria number 1, declining stock, declining 20. Criteria number 2, break through the 20 for the first time. Criteria number 3, pull back, and boom, a higher foot. Here's the left foot, here's the right foot. So guys, remember, when you have an even foot, it looks something like that, which we're going to go over actually. Left foot, right foot. And here you have left foot, right foot. It's on a slant. All right? Left foot, right foot. Left foot, right foot. So it's downward. Left foot, right foot. All right? Here you have left foot and right foot. You see? Okay. And then you hear, but here for the first time, you have left foot, and the right foot is higher. So now, if some of you will recognize this sort of like as a reverse head and shoulders pattern, but I think that's a little too involved. It's not necessary. The first right foot that's higher is the sign that you've bottomed. The first right foot that's higher. Your right foot wasn't higher here. Your right foot wasn't higher there. Your right foot wasn't higher here. But all of a sudden, your right foot is there. But not any right foot that's higher. The right foot that's higher, that's following the first break of the 20-period moving average. This is the quintessential right foot turn. Do you understand? So let's go over the criteria again. First, you have a declining stock. Okay? That declining stock is under a declining 20-period moving average. The stock is making lower right foots continuously. Lower right foots continuously. Okay? Now, for the first time, the stock is able to break through the 20, pulls back, breaks through the 20, pulls back, makes a higher right foot later. So it's the break combined with the higher right foot that's the key. It's the break followed by the higher right foot that's the key. Now, let me draw a different one here if I can and show you. This one might work, but it's not as certain. This one might work. Sorry, I did that wrong again. But it's not as certain because this move up didn't get through the 20. I like them best when the move up changes something as well as the move down changes something. See, here, the move up is changing something. That's my first warning. Now, once it gets through that 20, I'm saying, wow, I'm going to watch the next pullback, because if that pullback stays higher than the prior left foot, boom, I'm in on the next color change right there. Boom. Boom. Okay? So that's what I'm looking for. One more time. The reason why I'm doing this is because this is more prevalent than the V one. So we have to really understand this one. This one's going to happen a lot on you. All right? So, boom, we break through. Boom, we pull back. And right here, if I get a key solid color change, what's that? Green takes out strongly a red. Boom. Right there. All right. So that's the higher right foot bottom. And then here, this is wrong. This is wrong. I have the clearing bottom. That's a fourth one. Maybe I'll throw that one in as a, let me do it very quickly. Just because I have it here, you guys got a bonus. So it's really 4. All right. So the clearing bottom, guys, is, remember I told you that the initial bounce is usually not real. This usually falters. But if this goes sideways after that initial bounce and you attempt to move up here, and this move clears 5 bars to the left, this is what we call a clearing bottom. This is very different. There's your V bottom, there's your higher right foot bottom, and then there's your drop, drift to the side, boom, clear bottom. Now, what makes this so powerful is that it has gotten away from the trouble. It has moved away from its nemesis. It's moved away from danger. It's moved away from the pain part of the move. This move to the downside produced a lot of pain. People got hurt. People's lives were destroyed. People lost money. People hurt their families. But as the stock moves away from that pain, it moves the pain into the distance. So just like in your life, when you experience a bad relationship or some negative incident, it starts to fade in terms of its hurt and its pain. Its memory starts to fade along with time. Well, this drift away is time. Do you understand? And time heals all wounds. The further you get away from the pain, the more real the attempt to move up is. The reason why this move up is not as real most of the time is because the pain is still too close. You haven't had enough time to heal from the pain. The pain is still vivid in the market's memory. There are people that are still smarting over this, people who are still licking their wounds over this, people who are still angry at the stock. Do you understand? And so that initial move up is still filled with that pain. The secondary move up way over here is not filled with as much pain because it's moved away from the pain through time. And now the move up has less pain, less memory. It's more new, it's fresher, it's regenerative in nature, and the majority of the people who got hurt are probably gone. They've moved on. They've either left the game or they moved on to something else. And so this move is being driven by brand new players. This move up still has the players that are hurt and have a freaking bad attitude because they were hurt. There's no bad attitude on this move up away because most of the people with the bad attitude have gone, moved on to something else, left the game, and this move is being driven by brand new players. This is the clearing bottom. I didn't intend to give it to you, but there it is. And the key number here is it has to clear out 5 bars to the left in one fell swoop. Boom! That's your bonus. That's your bonus. All right. I'm only doing it just because I wrote it wrong. Really, what should be here is what I call the market law for bottom. ML stands for market law 4. I have a variety of market laws that I teach my traders. This is one of them. It's actually market law number 4. It's a market law number 4 bottom. Here's how it works. It's very similar to the higher right foot bottom, except that the market law 4 bottom is a series of lower lows, and instead of the higher foot, you make a relatively even low. So it fails on this pullback to make a significant new low. This or this. This is the higher right foot bottom. This is the market higher right foot bottom. And this is your market law 4 bottom. They're kind of variations of the same bottom. One just fails to come all the way back. Do you understand? Now, they're both very powerful bottoms. I will say that I would have to say, no, it just depends. They're both equally powerful. The only thing about the right foot bottom is that sometimes the higher right foot bottom, it takes place so high that you miss a big portion of the bottom. So for instance, like sometimes that higher foot is up there. Do you understand? And so in retrospect, you realize I had a V bottom. I didn't know it, but I had a V bottom because look at my right foot is way up here. What I like about the market for a bottom is that that you don't miss it, that it's come all the way back to the low. It has failed to make a new low, but you need something powerful here. You can't guess that that's the low. You can't try to catch a falling knife into the prior low there. You must have something powerful, a powerful green bar, a powerful color change, something powerful, something big, something bold must confirm this bottom is in. You don't just guess, all right? Because if that was the case, you would have guessed here and failed, and you would have guessed here and failed. You need something powerful that confirms the turn. Power green, power color change, power tail bar, power, bold, oomph. Nothing like, hi, Oliver. Nothing like that. We need it powerful, okay? Okay, now, let's summarize. And then I'm going to go to charts here for you, right? Let's summarize. We've got 4 now because I messed up, but okay, to your benefit. So we got 4 now. We got the V bottom. That's your V bottom. That is the rarer of the 4. All right, let me draw that again. So you got this. Stock's been trending down. Boom, V bottom. Okay. Now, there are ways, I can't go into that. It's beyond the scope of our live event here today. There are ways that I teach my traders to grab these V bottoms because they're hard to detect. There are ways, but it's beyond the scope. But this is the rarest of the 4, right? Then you have your higher foot bottom. Now, let's do that like this. So you're dropping, you're dropping, you're dropping, you're dropping. All right. You break through that 20, you come back, you create a higher foot, boom. And then you have the market 4 bottom, where you rally, you pull back, it could make a new lower low, boom, it doesn't make a new lower low. Market law 4 bottom. So let's do higher right foot bottom, market law 4 bottom. Okay. And then, of course, the one I told you about, let's do the V bottom here. And the one I told you about, right, that I wasn't supposed to tell you about was this one. Boom. That's your clearing bottom. It's happening away from the decline. All right. And these are your 4, really your 4 ways, major ways, not the only ways that you bottom. Your major bottoms are going to look like one of these pictures. I am telling you, traders, that if you get the right collection of pictures, do you understand? The pictures of all your buys, what do they look like? You got 4 buys, that's 4 pictures. You got 4 bottoms, that's 4 bottoms. How many tops you have? You got 4 tops, there's 4 tops. Do you understand? There's 3 sell events when you're in a trade. What are the 3 sell events? What are the 3 pictures? What do they look like? So this is a game of pictures. If you get the right pictures, then it's just it's matching the pictures. Okay? And then you need the right action for each picture. So what do you do when you get picture number 2? What action do you assign to picture number 3, bottom number 3? What action do you assign to bottom number 4? So once you have the pictures, then you construct the actions to take advantage of each picture. Then you wrap protection around the action. Once you make the action, how do you protect yourself if the action turns out to be wrong? You need a protection mechanism. And then how do you basically get out? How do you take profits? I mean, these are the basic components of a trade, but it starts off with knowing the right pictures. Every opportunity is a picture. Do you understand this? That's all it is. Money, the footprints of money create pictures. If you track the footprints, they make the pictures, and they make repetitively the same pictures at critical turning points. We're not interested in all the pictures. We're only interested in the pictures that suggest that we're at a critical turning point. These are 4 pictures that tell us we are at a major turning point. I'm going to give you one more bonus. I told you that I teach my traders some things to help them catch the most difficult bottom of all, which is number 1. Well, let me give you one of the keys to grabbing this, to knowing that this is a V bottom. This is not a higher right foot bottom. This is not a market law 4 bottom. This is the V. This is the rare V. I'll show you. See this low? See this left foot? Now look at this right foot. When that right foot is way down there, way separated from the left, it's a V bottom. You see, this is separated, but it's not separated like this one. Oh, up in there. Look at that separation. When it's elongated, when that left foot is way up there and that right foot is way down there, that's a V bottom. When it's more normal apart, this is normal apart, normal apart, normal apart, more normal apart, it's a potential higher right foot bottom or market law foot bottom. But if it's way apart, that's a V bottom. Second bonus I gave you today. All right. I'm hoping you appreciate these things. Guys, I was reminding my traders of this today. Do you understand that this is the gift that keeps on giving? Do you understand this? It's amazing, traders. Listen to me. One thing, like what I just explained to you, that distance, if it's extraordinarily wide, your left foot and your right foot, then it's a V bottom. That's the gift that keeps on giving. That one little nuance, that one little piece of information, that one little extra piece of knowledge can reward you for the rest of your trading life. Do you understand? Until you die. That one thing will deliver for you forever. It'll never stop working. It'll never stop being true. It will come up over and over and over again for the rest of your life. This is the value of having sound technique or concepts, knowing that they're sound and knowing that they are timeless, that they don't stop that one little extra thing will reward me for the rest of my life. That's crazy. And I try to give these one or two things every single time we meet. So they stack on top of each other. And that over a period of time, you have this stacked bunch of things that are paying you your whole life. It's crazy, right? I love this game. Guys, it's 42 years in March. 42 years in March. December is my 37th anniversary as a professional trader, but 42 years when I count the idiot years in March. All right? The idiot years came before the professional years. Everyone's got the idiot years, right? Everyone's got the idiot years, guys. All right. Let's take a look at some charts here. All right. All right, let's take a look at some charts. But first, I want to take a look at your faces. Let me see what you're talking about. Let me see what you're doing. Let me see what you're saying. Know what you're saying here. Earl is saying, but the MACD would also show oversold too, right? I like that. Guys, yeah, probably, maybe. But if you're going to use the MACD, right, something extra, remember you're leaving the price now. So what you'd probably want on that higher right foot or that market law 4, if you're a MACD follower, right? MACD is an indicator, technical indicator. You'd want a bullish divergence on the MACD to coincide with that higher right foot or that equal left right foot in the form of a market law 4. But let me just tell you something. It's just not necessary. Guys, I have tried and experimented with and used virtually every single indicator you can think of. Indicators that don't even exist anymore. Indicators that no one uses, no one's heard of anymore. Guys, I've used astrology as it relates to market turns in the market, which, by the way, has a little bit of validity, believe it or not. I have used every moving average type, every indicator you can think of. I've made my own indicators, and I've made a full circle. Years and years of trying to find the holy grail with something else. I've come all the way back full circle to focus on what? The only thing that makes me money is the movement of the price. These indicators are derivatives of the thing that makes you money. They're derivatives. They're apart from the thing. The item that makes you money is the price movement, the price, the chart, the item itself. And so this, if you bring an indicator into the game, it is indicating about the item. So you have something that is telling you something about the item. It is indicating something about the item. But if you have the item, why do you need to leave the item to go to something that is not the item, that is now giving you an opinion of the item, and you have the item? Like it's completely different if you don't have the item. Like I don't have the price. So let me consult with an indicator of the price because I don't have the price. But if you have the price, what do you need to leave the price for to go over there and ask that thing about the thing that you have? I need your opinion on the thing that I have. It just stopped making sense to me in a big way. Now, some people are more visual than others and they like to see visual confirmation of things. Fine. All right. Knock yourself out. If it helps, I'm all for it. What I've found is that when I give traders 8 different things to look at, they get tied up in knots every single time. I can't get them to freaking act because they're looking the three things they're looking at confirm and the fourth thing doesn't confirm. And they're like, but I can't take the trade because I'm now uncertain because this line didn't cross above that line. Get out of here. Higher right foot, color change, boom. And so what? If it doesn't work, so what? We move on. But I don't need anything else. Give me the price and I'm good. I'll throw some moving averages on there, the 20 and the 200, and that's all I need. I don't need to seek advice from anyone else. I don't need to seek advice from another squiggly line, and I don't need my charts looking like a freaking bowl of spaghetti. I like spaghetti every now and then, right? I can't have a lot of it. I'll blow up like a big house. I like it, but I do not like my charts looking like a freaking bowl of spaghetti with 150 different lines crossing this way and that way, keeping me tied in knots, keeping me confused. There's always, if you look hard enough, there will always be a reason not to take a trade. Always. You can always find a reason. You understand? We need to get to a place where we trade with authority, we trade with certainty, we trade with that instantaneous, bold action that is not filled with doubt. That's what the universe respects. The universe respects a man and a woman of decisiveness, of strong conviction, strong, powerful decisions. The universe reverberates when you make a strong decision. The market is our microcosmic version of the universe, right? It doesn't respect doubtful action. It doesn't respect kind of, I'm not sure, but I'll try it. No. All right, keep the squiggly lines keep the squiggly lines to a minimum, guys. Trust me. Focus on the thing itself. The last thing I will say about this is that indicators are usually lagging indicators. They have to be because they're indications based on what the price is doing. So you get the purest, fastest signal from the price. Later, the indicator might respond. And so you're always later than my traders relying on indicators. That I can promise you. All right. Okay, let's go. Let's go back. Let's keep it going, guys. Let's keep it going. Why not? Why are we not going to keep it going? All right, let's do this. Let's keep it going. All right, good. Guys, look, we're looking at bigger time frames here. All right, I'm teaching you the concept which I told you can be applied in all time frames. Why am I using the bigger time frame? Because I believe that in the future it's going to become valuable to you to be able to use a bigger time frame to determine when the overall market or your individual items have bottomed, and real bottoms are more confirmed on the bigger time frames. Okay, so here's a weekly time frame of Alphabet, Google, right? And so you see that rare V bottom that happened in 2020. Most things bottomed like this. All right, most things bottomed. Now, remember I told you that one of the ways to determine that you're likely a V bottom is that distance between the prior low. But in this case, we don't have a prior low. So how do you do it? The distance between the 20 and the low. So when that distance, let's say you were even to have this, and boom, you've got this 20 period moving average. And then all of a sudden down here, the distance from your 20 is so big, that's likely to be the V form because it's the same as the feet are so far away. So we don't have the higher foot here, but we do have the distance from the 20, that wide distance from the 20 to give us an indication that this is the V version. It's just too deep. All right, the 200 served as major support there too, which is really nice. Nice. Now, what's the entry? Your color change. All right, right off that 200, green takes out red right there. Boom! Here's your protection. The rest is history. All right, so V bottom. All right, that happens the least frequently. So let's focus on those things that happen more frequently, right? Like the market law 4 bottom. All right, this is my favorite bottom because unlike the higher foot, remember sometimes that higher foot can come so high that you've missed a big portion of the move waiting for it. Okay, so I like the ones that help me get boom right there. And that's that market law 4 bottom Gotta love it. Boom. Boom. Do that wrong here. Market law for. Somebody say, but Oliver, that's a higher right foot. Whatever. Whatever you want to call it. It's close enough. The action is the same. What are you waiting for to confirm that? Boom! Look at that green solidly kill a red. Right at the 200 period moving average, too. And the rest is history. Now, if you want to look at it from this bottom, look at it from this bottom. Look, drop, higher right foot, and the rest is history. Boom. So you got the market for here and the higher foot. You got kind of both. Wow. And here is a V bottom that kind of got deep below the 20 and temporary. That was your 2020 drop. Many things did that in 2020. All right. So again, market law for and higher foot. Oh, my drawing is terrible here. Boom. Boom. All right, cool. Now, take a look at another thing. Occidental. Now, this is cool, guys, because my wealth traders can tell you we scored huge on Occidental Petroleum in 2020, but we played the market law for bottom. All right. So I want to talk about this for a bit because this is something that you will deal with. All right. Now, you see how we dropped and then we kind of had a market for bottom there and a little tiny fake out. We almost eliminated the play. So in truth, we went into the market law bottom right there or right there. I can't remember. It's one of those or both of them. All right. Thinking that we got the market law for, okay, we're wide apart. That's a different concept as well. Some of you might be familiar with. I've taught you that. So we got the market law for, and I almost killed the trade here. And the only thing that saved me was our famous 2-bar stop. 2-bar stop rule. But anyway, we snapped back up. And then this thing went from, we did it at $8 and change. No, I'm sorry, that's right. Around $10 and change. It almost got stopped out at $8 and change or $7 or whatever. And then we went from 10 to 80 something dollars. Wow. That's a wealth play. But what led to the play, guys, which is crazy, is this concept I'm telling you. The market law for boom. Wow. All right. Cool. I should take the prices. The prices here. All right. Cool. 10 to 80. Not bad. All right. Here's the dollar. Here's a dollar index fund, right? Dollar's been on a tear. All right. Most of the world's currencies are collapsing into the dollar. That's what this chart shows you, right? A rising dollar does not mean the dollar is gaining in value. Guys, please understand this. Please understand that when you see the dollar, the US dollar chart rising like this, that it does not mean that the dollar is rising in value. It does not. It means that every other currency is weaker than the dollar. The dollar is stronger. So think of it like this. Think of it like here's the dollar, and that's going down in value too. But the others are going down in value like that. Do you understand? It's a race to the bottom, but they're all freaking going down, including the dollar. So some people say, Oliver, I don't understand that. What do you mean? The dollar chart's going up. How do you say it's not going up in value? No, no currencies go up in value. That's what inflation is. If we've got 9% inflation, how is that going up? It means you're losing 9% a year, right? The value of the dollar is losing 9% a year based on the reported inflation rate. I would double that. It's more like 18% a year. So please understand this. This is beyond the scope of our talk, but it's important to understand this, that a rising dollar chart does not mean the dollar is gaining in value. The dollar's just winning the race. It's losing the race towards zero. All right, so red is winning the race. This is in first place. Yeah, first place, heading towards zero. Purple. Yellow is in second place. Look at yellow, trying to take the lead from first place. And in third, right behind the heels of number 2, is red. Red currency is on its way to trying to catch up to 1 and 2 towards zero. Who's going to win the race towards zero? In last place is the US dollar. They're all trending towards zero. All right, guys, look. All right. I talk about these things in great detail with my wealth traders. They need to understand. Most people don't understand the concepts of wealth. They don't understand what money is, how it operates. These are the key fundamental things to understand. And unfortunately, we're not taught these things in school, as I'm sure you know. And that's on purpose, by the way. Because if we really understood what went on, we'd be revolting, right? So you can't teach the public these things. All right, cool. All right, so look, the dollar did a market law for kind of macro bottom here, right? Boom! And let me just tell you what locks it in for me that this is market law 4, really. Market law 4 bottom. What locked it in here was this. Look at that giant. Boom! To confirm that new low. Now, remember I told you that I wanted to start off with Oxy to show you what can be a typical version of market law 4 is that slight lower low. It's ever so slight. That's the trick. That's the trap. That's the knock everybody off the horse. Sorry, I spoke into the mic too close. Knock everybody off the horse once everybody's gone. And that's what happened here with Oxy. Be careful. Be careful of that trap. And if you get knocked out and it flips right back, get right back in, knowing you've got the market law 4. Get right back in. If you get tricked, get right back in. It's got to flip right back almost immediately, though. All right? Don't stay kicked off like that. All right. Here, market law 4. Boom. Okay, beautiful. Look at how nicely the 20-period moving average is just containing all the activity. Getting a little overheated here. All right, you see how far away you are? All right, so we're a little overheated with the dollar right now because this is grabbed just today, guys, just for you. For the benefit of your learning. Grab this today. All right, another kind of dollar index here. Some people might say, well, Oliver, this one is the right foot. Okay, boom. There is your confirmation. Higher right foot or market law 4. I don't care which one you interpret it as long as you interpret it as the bottom. So, we were in the throes of a downtrend here, and boom, your failure right there to make a new low, and boom, that's all you need. I don't care what another indicator's saying. I don't care what your consultant at the psychic hotline center has said. I don't care what your trading partner, friend, chat room buddy has said. I don't care where the planetary alignment of Mars is in relationship to the moon. This is a freaking bottom. Higher right foot. Boom! Solid confirmation. You've got the bottom. All right. You don't need anything else. Bottoms in. Okay. Then here you have a little Netflix bottom here going into 2019. We come way up here and we retest. When you're retesting, you're looking for, are we just going to go to a new low? Or are we going to hold and form either a higher foot or a market law 4? I don't care what you call this, market law 4 or higher foot, you've got the bottom. Now, oftentimes, guys, the wider apart, the more powerful. So look at this one. Not as powerful as this one. You see? This one will be more powerful than this one. Remember what I told you, because this one is away from the trouble. This one's still close to the trouble, right? So this low, you're away from the trouble. Now that rise can be real and not just temporary. Remember that concept there. All right. Valuable nuances here. Alibaba, market law 4 bottom. Beautiful. Right into. Boom. Green takes out red right there. Market law 4 confirmed. You're in there. You're in there. All right. Now, look at this one. Look at this one. You see how close it was? It still worked, but temporary. It's this one. And that green bar right here clears the red. The rest is history. I know you guys like that sound. Yeah. Federal Reserve can print their money like that, right? We can print ours like this. All right. Okay. Remember, I was telling you that the ones I like really break the 20 the best. The ones I like the most, they kind of break the 20, right? And then I watch how they retest. But sometimes they don't break the 20 and retest. I like the ones better that break the 20, but this one still can work too. But you need something powerful to confirm. See the power that confirms? Boom! Rest is history. Oh no, let me check another line on my chart. Let me check Saturn. Psychic hotline, anyone? Psychic hotline is at the bottom? No? See? You don't need anything else, guys. Just hit the buy button. Boom, protect yourself. If it doesn't work, man up. Move on. It's okay. Life is about dealing with loss too, you know? Just have to lose intelligently. That's all. All right. Why is there such a fear to lose? I don't understand. There's a direct relationship between masters and how much they've lost first. Every master lost a lot. There shouldn't be a fear of losing. You understand? I don't know what it is about our culture that teaches this. Why is this so ingrained? You know, we should be rewarding kids for trying and failing instead of, well, not entirely, but you know what I'm saying? Like if a kid tries something bold and it didn't work, should pat him on the back. Get him next time. Don't worry about that. That's good. All right? Don't let that stop you. Right? Instead of punishing them for failing. Now, I'm not talking about giving rewards for the losing team. How ridiculous is that? Like you lost and you get a reward? No, I'm not talking about a reward. I'm talking about go get them again. You lost, man up, woman up, go get it again. No freaking reward like you won. No, 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 no. I don't believe in that. A loser's a loser. Okay, here is the V bottom, guys. You had a V. I would take this first one as a V bottom. Why? Because we got so far below that 20. You see, this is not far below the 20. This is not that far. This is way below the 20. This is not that far below. You see, even this got far below. So the odds far below is that it's a V. So I think that taking this one as the V, there's your confirmation right there. See that? Boom! Now, if you have to wonder, is that confirmation? It's not confirmation. If you have to squint one eye and kind of, I think, no. Confirmation is powerful and it is irrefutable. Do you understand? All right. So none of this, I think it is. I think if you're thinking, it's not it. That's clear, powerful. Okay. And here's your right foot version. You see? Higher right foot version. Oh, why am I writing so terribly here today? Higher right foot version. But see how you kind of lose this, right? It's a little high there. So I like them both. I mean, this is a very powerful buy right here. Shoot. This is a powerful buy right here, this bar. But so is this one. All right. Okay. Beauteous. Okay, is the QQQs here. All right. This is when the market was rallying. This is an inverse ETF, inverse to the NASDAQ 100. First time it gets above. Look at that. And boom, catches. And the rest is history. Higher foot, higher right foot, 20 MA halt thing. My traders know that is the 20 MA halt. And we're off there. Now, I know some of you say, well, Oliver, does this work with tops? Yeah, it does. I'm not focusing on the tops because we're not in a market where the next thing is going to be the market topping. We're in a market where the next thing is going to be the market bottoming, whether that's later this year, whether that's into 2023, whatever. Remember, we don't have to know when, we just have to know how to identify it when it happens, right? But as you can see, here's the lower right foot, here's the opposite, boom. So you weren't breaking the 20, right? You see? And now the first time you break the 20, and then you make a lower right foot. Well, I guess that wouldn't be a foot, would it? A lower right top or whatever. Boom. Okay. Now, look at what you're dealing with here. First time breaking through. Uh-oh. Do we get something like... Boom! Do we get something like that? Boom! Do we get something like that? Do we have to know? No. When it happens, will you know what to do? Absolutely. This is why I wanted to focus more on the bottom part. All right? Now, we'll focus on the top part a long time from now, but oh, I did that wrong. Here's another top one, right? Roku. All right? This is your market law for top. Boom, there's your elimination of green right there. Come in, red eliminates green, and the rest is history. Wow. You'll find that almost every one is one of these four. Here's PayPal's top, right? Look. Market law for top failure to make a significant new low high, and look at your confirmation. Boom! Instead of like this, it's like this. Boom! The opposite way. All right? There's nothing that's unmistakable. There's nothing questionable about how powerful that is. It's confirming, yeah, I've got the top. Right? Beautiful. Now, do we get something like this? Hmm? Hmm. Hmm. First time getting through during the whole freaking down move, right? The first time. And here we are. Will we get? Do we have to know? No. But when it happens, will you know what to do after this? You will. You will. Time and space. Using the concepts of time and space to time turns in the market. When I talk about a market, guys, I am telling you that I am talking about any market or any individual item that trades inside of a market, anything that human beings trade back and forth. As a reminder, everything that I teach you is universally applied across all markets. I don't care what market you trade. And it's universally applied across all time frames, whether you're a micro trader, a swing trader, a day trader, a macro trader, it doesn't matter. The time frame you trade doesn't matter. The market you trade doesn't matter. I believe that true truths, authentic truths in the market are universally true no matter where you take them, whether you